Investors Chronicle.
A quick note before we begin to say that nothing discussed on this podcast should be taken as investment advice or a prompt to buy or sell. As ever, please do your own research. Hello and welcome to Lee and the IC, the podcast in which you, dear listener, get to hear from one of the longest practicing and most successful private investors in the UK, Lord John Lee of Trafford. I'm Alex Newman, an associate editor at the Investors Chronicle, asking the questions as usual. However, we're not in our normal setting, but 10 floors up in the middle of the city, in the offices of FTSE 100 financial services giant M&G, which, as regular listeners may recall, is John's biggest holding and probably the stock we've spoken about more than any other, all of which means we're very grateful to be here with M&G's Chief Executive, Andrea Rossi, who has kindly agreed to speak with us today. In our first podcast 2 years ago, John described M&G as once resembling something of a stranded whale on the UK market. Andrea, what was your impression of the business before you joined in 2022? And feel free to use any animal metaphor you wish.
Well, when I joined in 2022, I saw M&G as an enormous potential with strong opportunities of growth, of transformation. And the reason why was because they had a very strong investment manager and they had, of course, a balance sheet in the life business. And that combination, if you manage to make it work properly, can be an amazing competitive advantage. So I saw enormous potential and, of course, a heritage, having invested since 175 years, all that made me want to come and succeed. And we managed to, together with my team, to come out with a clear strategy, clear targets. And I'm glad to say 3 years on, we're very, very pleased with the outcome. I'm very, very pleased to hear that John has a significant holding in M&G. I hope I have been successful in delivering on your expectations.
Very helpful with grandchildren's school fees, I have to say. But just going back on the start, there were a number of commentators and others who suggested that really the group should be broken up, and you were I know absolutely adamant that you wanted and intended to keep all the parts together because you believed that gave you a distinct commercial advantage, and I think you've been proved right.
Yes, no, it's true. There were many sell-side analysts, even some investors saying, why don't you break up the company? The reality is when you look at the financial services sector, in particular asset management, the focus is on private assets. Many people want to grow in private assets. And if you have that permanent capital you get with the light balance sheet, that really supports the growth, both in private assets, but also support the growth in public assets. And why would I give away on our largest competitive advantage? And I always like to say that to summarize what we are, we have a rather unique investment solution in the Proof Fund. I'm sure many of your listeners will know Proof Fund, but that describes very well what M&G is, because it's an investment solution that has a component of private assets. It delivers investment return of 7% since 21 years on average per year. And more importantly, we smooth the volatility. And of course, we use the two businesses in order to deliver this because we utilize the strength of all our investment capabilities of the asset management business, but we utilize then the balance sheet in order to smoothen and also give the asset allocation to the strategy. So I think the strength of the business is having these two businesses working in a synergistic, balanced way. And I think the results that we have been delivering over the 3 years, and in particular the last half-year results, has proven us right.
Andrea, if we sort of rewind the clock again, kind of 5 years or after the spin out from Prudential, one reading of the asset management sector is that it sort of rested on its laurels for far too long. And then when it came to make the big strategic decision, do you go passive or private, the city just waited, and you've got lots of your peers that were struggling and continue to struggle. Yeah. It seems like you've, of the choice you had there, you've been more on the private side. What do you see in private markets?
Well, I always think, first of all, we should think, I believe today it's the golden age for asset manager again, because the reality is We have rates that we did not have years ago. And having rates means that there is more volatility, but also opportunities of investments. But then we have governments who want to invest in infrastructure. Think about the UK, but also Europe. Defense, energy, technology, big projects in all this, transportation as well. But of course, governments are heavily indebted. I think every country has a debt ratio over GDP over 100%. So they do not have the money to support this transition. And that's the opportunity, of course, for asset managers. And that's why private assets has such a big opportunity. And let's not forget the last point as well. Banks are retrenching their balance sheet, so they're providing less loans out to the economy. And once again, that's an opportunity for private markets, for asset managers in private credit. So we see a lot of opportunities in this sector. But the key sort of competitive advantage in order to be strong in this sector is to have permanent capital. If you ask every asset manager in the city what their priority is, everybody will say, we want to grow in private assets. And they have been acquiring businesses, or they have been trying to make it by themselves organically. But if you really want to fuel, if you want to expand quickly, you need to have access to permanent capital. That's what has been the success of M&G. And that's why we have been able to build this franchise of 77 billion sterling in private assets in Europe. One of the largest one, and I would say probably one of the most successful one, in particular in real estate, private credit, and infrastructure, which are key private assets segments for insurance companies, but also pension funds.
I think you said in the last interim statement that something like 58% of investment funds were actually from overseas.
Yes,
which is
it's the client. It's the client. Yeah, it's the client.
Yes.
We have significantly also diversified M&G. We used to have only 37% of international clients of our external assets. That was 5 years ago. Now it's 58%. So we have been growing that internationalization 11% per year in the last 5 years. And I think that's great, but it shows also that there is appetite around the world for what we invest in. And of course, we invest in the UK, we invest in Europe, we invest in Asia, in the US. But there is a lot of appetite, in particular for European private assets. When I say Europe, I include UK in Europe, right, just to be from a regional perspective. I'm not saying EU, Britain. It's Europe.
And when you say external clients, aren't all clients external?
No, because we have roughly 350 billion assets under management, asset manager. 48% of that is internal money from our live balance sheet. 52% is coming from outside. That's why I'm saying external and internal. But of course, we treat our clients exactly the same way.
This permanent capital thing, I sort of get it, but at the same time, it seems very, very hard to value a business like yours. Earlier this year, there's one analyst pegged your shares value at somewhere between £2.20 and £5.40 on a sum of the parts basis, yep, which is a sort of way of saying not quite sure, I think.
Yes.
If the city destroys to define what you're worth, I'm guessing investors do too. Can you help? Are there sort of metrics that you say this is the thing you should be focusing on?
I think and you hit the right point. What are we and how should we be valued? Now, I get very upset when people call us M&G the life insurer, because we're not just a life insurer. We have a life balance sheet. And by the way, that life balance sheet was in runoff, and we sort of have reignited it, and now we have re-entered the market. But we're not only an asset manager either, because we are the combination of both. I would call us, we're like a diversified financial, we're an investment and savings company. And then the point is, okay, but then how do we value you? If we look at, for example, multiples, roughly UK life insurers, they trade roughly at 9 times earnings, 9.5 times earnings, forward earnings. Asset managers, if you look at them in Europe, they trade roughly at 11, 12 times forward earnings. I think we are trading at 8.8 times forward earnings. So we're not even trading at any one of those two. So already there, you should see significant potential value creation. But I would say somewhere there in the middle, if you think that we are one in between, we should probably be at 10, 11. So I see, of course, that there's scope of opportunity. But I guess what we need to show, and what we're showing, is we need to show profitable growth. And I think that's what our strategy has been focused on from the beginning. We want to deliver profitable growth, but we want to make sure it's sustainable. And in order to do so, you need to make sure you have strong foundation. because you can create growth very quickly, but if you don't have strong balance sheet, if you don't have strong processes, if you don't deliver great outcomes to your client, it will be very volatile. I want to make sure I deliver sustainable growth moving forward. So we have been focused in the beginning on 3 pillars. We had financial strength was the first one, because you need to have a strong balance sheet, first of all. So we focused on liquidity, Solvency II ratio, and leverage, and making sure we were delivering capital generation. And these are all things that we have strengthened over the last 3 years. At the same time, we wanted to simplify the business. We can't be everywhere. We need to stop certain things, but we also need to make sure our processes are stronger. So we're simplifying our processes, taking out costs, and reinvesting those savings into initiatives of growth. And we've been successful in that as well. And interesting enough, you have seen in the last year, we have seen significant growth coming back for the business. This business was not growing when I took it over 3 years ago. It was a business which had no growth. The asset manager had outflows. The life business was in runoff. Today, we have a business in life which is growing again, both with Proof Fund and with BPAs, and the asset manager is in positive net inflows. So it's been a journey, and it's a journey we want to see continued. But I think the key here is to look at us as a business which delivers yield, because we deliver a good yield, a dividend yield to our shareholders. But more importantly, now we're also delivering new growth. Hence why we have committed to a progressive dividend policy. I think this is very positive for the market and for existing shareholders and hopefully potential new shareholders.
Just to stay with the valuation point for one more question. I mean, is there an argument that the complexity of the business, and it is a complex business. You've got a life insurance book, as you said. You've got liquid and illiquid assets. You've got a balance over multiple durations. That creates the perception that, there may be hidden risks, or, I always notice if there's a kind of political or interest rate sort of flare up or worry. You've got, your shares, L&G's shares, Aviva's shares, they all sell off because people get quite concerned that there's going to be some hidden gremlin there, or interest rates are going to blow up. What do you say to that?
My view here, once again, is linked to the business model. We can withstand and be resilient in any interest rate scenario. And I'll be more specific. So if rates goes down, then that is very positive for the asset manager, because effectively my valuations goes up in fixed income, but also in private assets. And that, of course, then is what I charge fees on. So that's positive for the asset management business. It is instead a headwind for the life business, because the assets that they manage, they will return less in terms of, let's say, yield, and you have also some consequences on the Solvency II ratio. So that's when interest rates are going down. But if interest is going up, it's the contrary. It's very positive for the life business, and it's less positive for the asset management business. And this is where I'm talking about before. The balance of these two businesses gives us that resilience. So I'm a little bit surprised when every time we see these things, and we always sort of are linked to pure life insurers, and sometimes they link us to pure asset managers. They should think of us being rather unique. And this is what I'm trying to get out as a message out there. And I think we're starting to see sell-side analysts understanding more what the business is about. And we should think about some of the more successful American firms that have this model that M&G has. You probably will have noticed that some alternative asset managers, big ones in the US, have come into the UK market and have entered the BPA market, acquiring BPA or life insurers. The reason why they have done this is because they believe in this model of permanent capital and private assets or asset management. They trade at 15, 16, 18 times earnings in the US. They're what I call diversified financials. We're the same. Now, it's the US, we're in Europe, but I'm not sure, a differential between 8 or 9 to 16 is the right one.
You're not planning to move the quote to the US, are you?
No, definitely not. No, definitely not. And let's be very clear. We are focused from an asset management perspective and client base. We're focused very much on Europe and also selectively on Asia. We want to be the leading asset manager in Europe, in particular on private assets.
On that point, on the takeovers and the entrance into BPA retirement product space, I was speaking to a fund manager recently who held Just Group, which is they've been the process of being taken over by Brookfield,
Yep.
a competitor of yours in some areas. He said they're always too hard for public markets to value, and he thought that this was private ownership was the better model, which it sounded a bit of a cop-out to me. But, you are a champion of private markets. Would private ownership be a better fit for a business like M&G in the long run?
I think, private versus public, it's a long discussion. I believe when I look at our business today and what we're delivering for our shareholders, the fact that we are being measured by a market, I actually like the challenge of having that market sort of giving us a valuation. And let's not forget, if you are in the market, you have shares that potentially you can use one day if you want to do certain activities. So there are pros and cons for both. But I believe today we have a clear strategy. We're delivering on it. We are also delivering, I think, for our shareholders, both in terms of dividends and also the share price going up. I think from a total shareholder return, we're roughly at 33% per year in the last 3 years, every year. So no, it's a good journey to be a public company and as M&G.
Can we touch on probably the most important corporate development, which was the link up with Dai Ichi and the suggestion that they were going to, or the commitment to buy 15% of the equity. The thing that surprised me at that stage was that they said they were going to buy the 15% in the market. Normally, I think one would have expected them to have subscribed for new capital to the tune of the 15, to give them
Yes.
the 15%. So in a way, it potentially put the price against them in terms of buying the shares, and they don't seem to have made too much progress on that front. Would you like to comment on that and how that relationship is developing?
Yeah, I mean, I first of all, the partnership and relationship with Dai Ichi strategically is a very important one for us because it gives us access to a second balance sheet, a $310 billion balance sheet. So we have our own balance sheet, and I've been insisting on the competitive advantage of having a balance sheet in asset management. Now suddenly I have a second balance sheet with Dai Ichi Life that has committed to allocate some of that balance sheet to our asset management business. We have de facto become their preferred European asset manager, and they have a commitment of $6 billion over the next 5 years, which is significant. It's not small over effect, and with a $1 billion commitment per year for the first 2 years. So that's the first point, which is important because they will support our private assets and in particular high alpha strategies.
Sorry, Andrea, just jumping on that point. I mean, you manage $350 billion of assets.
Yes.
Is it a significant amount?
So it depends how you look at it. So obviously, if you look at it overall on the assets, you might say it's not that much, but you should look in terms of flows. Remember, these are going to be gross flows for us. And yes, now we have positive net flows, but I am very pleased to see not only the opportunity of having them as a partner, but getting these flows into high alpha strategies, namely private assets, that will enable us to accelerate even further because in that space, having size of the investment fund helps. And if you can go and speak to other institutions, pension fund, and saying, we have invested our own money with our own balance sheet, Dai Ichi Life has invested with their money, the discussion with big sovereign wealth funds, other big insurers, other big pension funds becomes much, much easier because we have skin in the game. So no, I think it's critical. Now, of course, a partnership can be just commercial, but here there is a strategic partnership also in the sense that they loved our equity story. They liked the fact that we have this business model of life insurance providing permanent capital and a very strong asset manager. And therefore, they wanted to invest. We were very clear from the beginning, we would not issue any new shares. So if you want to invest, you have to buy in the market. And that's why they're buying in the market. And there is a reason why they have committed to 15%, because they would like to be able to consolidate the earnings. And under Japanese accounting, you need to have 15% and a board seat. So they will receive a board seat when they arrive to 15%. So they're incentivized to get there as well. So that's why. So I think that's great. And of course, there are also rules that they cannot in any way take us over. So there is a standstill at 19.9%. They cannot go beyond that. So it's a long-term partnership. I think what is critical here also is Japanese institutions are long-term investor. And generally, when they commit to something, they always deliver much, much more. So I think this number of 6 billion is just a start. Obviously, we want to grow more. And last but not least, this partnership puts M&G on the map in Japan. Suddenly now, every Japanese institution wants to speak to us. We're suddenly much better known because Dai Ichi Life is the largest listed life insurers in Japan.
So it's not an exclusivity thing?
It's not an exclusivity. No. We can work with all the other institutions, and we are in discussion with other institutions in Japan. So they have really helped us to boost our visibility. But it will also boost our visibility in Asia because they're a significant player in Asia, in several countries in Asia. So no, it's a great partnership, and obviously we're very, very pleased with it. They're already doing several due diligence on some of our investment strategies, so we should get some mandates before the end of the year.
Could you replicate that type of deal elsewhere in the world, Andrea? Is that a possibility?
Oh, it is certainly a possibility. The reality is we have many institutions out there who are looking to see how they can have a preferred access to certain asset classes. And of course, if they look to Europe and they want one of the strongest, if not the strongest asset manager in Europe, both on public and private assets, we are very well placed to take that role. So yes, there are other opportunities, both with what I call asset owners, so people will have a large balance sheet, but also potential with large wealth distributors who are looking for commercial partnerships.
Because I remember when we first met at your AGM, I think 2 or 3 years ago, you said that one area of focus for you was going to be the Gulf.
The Gulf, yes.
And that you felt at that stage that M&G really weren't sufficiently represented in the Gulf in terms of relationship and funds flowing back here.
You're totally right. We were not even present. They did not even know M&G in the Gulf. And indeed, 2 years ago, I said there were 2 large regions where you would see interest in terms of flows, allocation, Japan and the Gulf, because they are effectively internationalizing their own asset allocation. It's been very much focused on US, to be very fair, but Europe has come back a little bit in the last years, not last month. So this has nothing to do just with Trump. I insist on this. Already last year we saw more appetite into Europe. I think it's due to also valuation and also a political agenda that Europe is pushing forward. We talked about the infrastructure before. So no, we've seen more appetite, and of course there are big flows, big sovereign wealth funds in the Gulf, but also some big institutions, and the same thing, of course, in Japan. So yes, we have started with Japan, where we're looking to see how we can expand other relationship or commercial relationship.
And Kingdom from the Gulf, they've got still a significant holding. It was, I think, 5-6%, something like that.
Yes, we have as a shareholder the Kingdom of which I think they have
6%. Yeah, I think so. Yeah,
6%. Yes,
which is significant.
Yes, which is significant. Long-term investor. Yes.
So to bring things back to the dividend, we have sort of touched on it, but maybe not explicitly about in the context of how you allocate capital, Andrea.
Yeah.
I don't want to put too much of a cat among the pigeons, because John, I know how important the dividend stream is to you. But I mean, you inherited this level of distributions. In an ideal world, you have got lots of potential destinations for your demands on your cash. Would you have a lower dividend? Are there places you would prefer? I know you have a dividend policy and you're not going to change that, but are there places you would like to be putting cash to work elsewhere?
It's true. One has a lot of opportunities, but we have a very clear capital management framework, and we stick to that one. Since I arrived, we've been focused first on the financial strength. So we have strengthened significantly the balance sheet. Our Solvency II ratio is at 230%. We deleveraged, so we bought back some debt to reduce our leverage. And we have strengthened liquidity, and we have been continuing to deliver strong operating capital generation. That has been a focus. And at the same time, we've been investing to transform the business for profitable growth. So we have been investing in restructuring the business, but we've also been investing in significant initiatives like technology, digitizing our processes, but also some bolt-on acquisitions that we did, in particular on the private assets, 2 bolt-on acquisitions. All that has given us the comfort that we, on the dividend policy, we moved to a progressive dividend policy, because before it was just delivering attractive dividends to our shareholders. But we moved to a progressive dividend policy because we felt our business was now fit in order to deliver profitable growth moving forward. And that's our focus. That's our focus at the moment. And I think that's a good model, because you want to make sure that when you think about dividend, and you want to deliver good dividends to your shareholder, but you need to make sure it comes from your flow of the business, not from your stock, and not from, because the stock is a different thing. Stock can be there for shocks, stock can be there for other things, but it should come from your underlying business results. And that's what we've been focused on. And I'm pleased to say that in the last 3 years, we have been significantly improving the underlying business. I mean, we are more profitable. I can give you a couple of examples. The asset management business had a cost-to-income ratio of 79%. It's 75% now. We have been improving it, and we want to continue to improve it. And it's the same thing we'll be doing in the live. So we are very much focused on making sure that we sustain our dividend. And I'm pleased to say the progressive dividend should be, our shareholders are pleased about it, but it's also underpinned by a real business momentum behind it.
Earlier this year, I think M&G was on record in its plans to step into the ETF world, quite a crowded space. Is that still on track?
Well, we're an active asset manager, and I stand for being active. I don't think you can be active and passive. So there is an ETF space, which are the active ETFs, which we are looking into, because in some markets, it has momentum, in particular in Germany, for example. So yes, we are working towards to see how we can enter that space. But let's be very clear, we will continue to be an active asset manager.
Okay. The FCA is also about to sanction crypto ETFs. Is that a party you're about to join?
Listen, I mean, when I look at our stellar investment performance, I mean, let's not forget, of our OIC and mutual funds, we have over 1, 3, 5 years, roughly 75% in the first and second quartile. But more importantly, we have roughly 20% in the top decile. When you have that, you have enough in order to get the flows out there. And that's our focus, whether it is on equities or on fixed income or multi-asset solution. Crypto is something at the moment we are not really looking at.
Good to know. I know John's pretty averse himself, so...
Not for me.
John, I don't know if there's anything else.
Yeah, well, just finally, because you've been very frank and obviously we appreciate it. The final question that I normally ask of chief executives is taking everything into account that you can talk about and have talked about and what you know privately, on a scale of 1 to 10, 1 being very pessimistic and 10 being very optimistic about the future, where would you put M&G now? What figure would you go for, taking everything into account?
Well,
some people say 11, I have to say.
I'm an optimistic person, so I have to be careful, because I generally see always the glass half full rather than half empty. But I would say we are in an environment which is volatile. But when I look at the way we're set up, and we went over, for example, rate cycles, how we can be resilient. But then I look also at the strength of our businesses and what we have. We have something which, the With Profit Fund, which is a very unique setup, which allow us to potentially take on risk at a lower cost of capital. I think that's a competitive advantage. We have the Proof Fund, which in my view democratize private assets out there. So it's a solution that we can significantly grow in the UK, we can grow in Europe and elsewhere. And then we have a very strong asset manager. So when I look at what we have, and also the momentum we have, I would say I'm rather positive looking forward. So yes, from 1 to 10, let's be a bit conservative. I would put ourselves 9.
Right. Right. Okay.
So yes, let's say I'm rather optimistic.
It's more than half full. Yeah.
Well done.
I'm sure there's lots of other areas we could cover, Andrea, but let's leave it there. And thank you so much for giving us your time today.
Thank you very much.
Okay, John, it's just the two of us talking now. Let's finish, as we always do, with a look at your portfolio since we last spoke. Listening back to that first podcast in September 2023 when we discussed M&G, I think your holding then was second in size only to Treat, whose shares were probably around £5 then. The flavourings group has sort of really struggled since then. Shares dropped to below £2 this year, but they've just accepted a takeover bid at £2.60. You weren't too perturbed with how this is all panned out?
Well, obviously, I'm very disappointed, as indeed all Treat shareholders are, that really the business that was where the shares were up to £12, now a bid is recommended at £2.60. There've been a number of fundamental reasons for that: management changes and changes in the market and management mistakes, unquestionably. But we are where we are. I fortunately managed to sell 20% of my holding as the price rose from £4 up to nearly £11. But it's still a significant holding. The point really is that I think the 260 level is clearly not going to have the support of shareholders. And you can read that from the bulletin boards. The shares are slightly above that. But the big thing is that the company is now in play. And we will see, because I know that a lot of companies, private equity and trade, who've been circling and looking at Treat. So we'll see what happens.
So you think a counter bid is realistic?
I think that there has to be a serious chance of a counter bid. And one or two of the ARBs, Coastal, have built up a 9% stake, and Harwood also have started to buy. And so I think there's quite a way to go in this story. But unquestionably, compared with the worth of my holding 3 or 4 years ago, it is disappointing that it's come down to the level that it has done.
Well, just as well, M&G made up for it. We've also had pretty good results from the animal nutrition company Anpario, whose CEO we had on the podcast last year as well. What's the story?
Oh, well, Anpario is one of my favourite holdings. I've been in there for a long time, 20 years of increasing dividends. It's a mini global business, and it's really in the right space because their products support natural animal growth. Increasingly governments are outlawing the toxic. And so the natural is the way to go. The world population is increasing. Countries are getting wealthier. Populations are getting wealthier. They made an excellent acquisition in the United States, which is turning out very well for them. And to me, it's a company that really ticks all the boxes. It's actually written up in the Investors Chronicle by Simon Thompson, who was projecting a further increase in growth and share price. So it's one I'm very happy with and has served me well.
Yeah, all their products are, I look at the results, they're all made from oregano, aren't they? I didn't realise how profitable oregano could be.
One of their base materials, yes.
Ditto, and it feels slightly unusual to say PZ Cussons, once again, profitable. That's been one of your long struggling holdings, but I think it's been no more news on the disposal plans that they...
The divestment from Africa.
Yeah.
No, I mean, obviously, I have an attachment to PZ because I was on the board, 20, 30 years ago, and I was very much involved in the acquisition of Cussons for them. But it's been a sad tale in recent years, with the capitalization coming down from 1.8 billion to just under 300 million before the very recent results. A combination of the Nigerian devaluations, but also some management mistakes, unquestionably. But nevertheless, excuse me, there is a massive, even though now things have started to turn, and there's quite a positive statement in terms of the things that they're doing and their UK business, things pointing in the right direction there. There is still a long way to go, because there's a very big gap between present capitalization in the stock market and the real worth of their brands. Brands like Carex and Child's Farm, Imperial Leather, these are well known. As far as the divestment from Africa is concerned, that has taken longer. I think it's complicated because, of course, they have a quoted company that they control in Nigeria, but there are minority shareholders there. But at the end of the day, that is a valuable business that's been built up over 100 years. And Nigeria, with all its problems, is still a massive growth market. I think in 3 or 4 years, it's going to be the 4th or 5th most populous country in the world with a very young population. So their business there, as leaders in consumer products, is very valuable. And I wouldn't want them to give that away. So it remains to be seen. I think it's work in progress. But overall, having had a discussion very recently with the chief executive, I'm pretty confident that they are now moving in the right direction. And I'm optimistic that there will be a steady recovery in the PZ price.
Just final couple of companies. I mean, we've talked a lot about defence stocks as a theme over the last year and a half. Concurrent Technologies, another company we've interviewed on the podcast, also seem to be
Concurrent is a great business, and Miles Adcock there has done a wonderful job in the 3 or 4 years he's been there. I've seen my holding in Concurrent in value quadrupling. It's chasing M&G quite hard.
Okay.
Now. They're 80-90% focused on defense, particularly in the US, working for US primes. And they've got some superb products that they've recently brought out. And actually today they've announced a new contract. So the outlook there is very good indeed. It's one of the most exciting companies we've got in this country, Concurrent.
Yeah, and Goodwin's as well.
And Goodwin is an amazing family-controlled PLC that hardly anyone knows about. But their product range is quite incredible. And they are crucial on the defense side. They're crucial to our submarine program, but also to the US submarine program. You wouldn't believe this, but they're a very important supplier to the US Navy. And they've got a whole range of other products as well, including something that is hopefully coming on stream called Develco, which they put a lot of money into, which is just now being tested commercially, which is a high temperature polymer. And only DuPont in the world apparently can produce this polymer. They believe their product is better and will be cheaper. So there is a real global opportunity they see for Develco, but that would be additional cream on an already very substantial and very growing business. And I think it's probably the best kept secret on the UK market, possibly apart from M&G. Second only to Rolls-Royce, it is a superb business that hardly anyone knows about.
We're doing our best to undermine these secrets on the stock market. Maybe we'll leave new positions for next time, because I know there's always more to talk about in what you're thinking about in terms of new companies you're investing in. But if you have any questions you'd like to put to John or suggestions for future guests, you can do so by emailing me at alex.newman@ft.com. Until then, all that's left for me to say is to thank you for listening. Thank you again to Andrea for his time, to John as ever for your thoughts, and to our producers, Maddie Apthorpe, John Johnson and John Downing. So until next time, goodbye.